So I'm curious to know, if you've traded stocks before, comment down below in Kajabi and just say, I've traded stocks. This is my first time trading Forex. I want to know how many of you guys watching this have traded before versus, hey, Forex is my first step. I want to get started day trading. I want to start with the Forex market because I've heard people making money in it and I want to take advantage. But maybe you don't even know why other than you've seen people making money. In this chapter, I want to explain to you why you made a good decision to choose either to add the Forex market to your trading tool belt or to just build the whole belt around the Forex market. This is my favorite picture to explain the difference between Forex and stocks. It's David and Goliath. Everybody knows this story. The stock market, yes, in David and Goliath, the stock market would, in this case, kill the Goliath, but we're not fighting today. We're just walking past each other on the street. I want you to visualize the size of the Forex market being Goliath, the size of the stock market being David. So keep in mind, and I've said this before, this is not the stock market. Number one, there is less manipulation in the Forex market compared to the stock market. We've all heard stories about so-and-so had a press release come out and now their stock is down 17%. Or, for example, Virgin Galactic was a stock that I owned earlier this year. A lot of rumors would drive the price action of that stock. Nothing to do with the fundamentals of the company, nothing to do with if they've generated revenue or not, or how much money they've made, or potential new products. Those things could also manipulate the price, but you have the potential in the stock market to have negative influence from a press release. I don't think that's a great place to be actively looking to put my money to work. I would much rather go to a market that has less manipulation. No herd mentality, no nothing like that. Another key pro that I think makes Forex better than stocks is you can buy or sell a currency pair, whether you think it's going to go up and you want to buy it, or if you think it's going to go down and you want to sell it. It's very easy to do. Whereas if you were trading stocks, you have to sometimes go borrowing shares in order to short a stock. Now, at the time of filming this video, a lot of people are saying we are going to be headed for, if not already in, some type of slowdown economically, which is always tied to the stock market. The Forex market is separate from that. The Forex market doesn't have bull or bear markets, and that's why we can go in and buy or sell it very easily. And this goes back to what I said about the competition from the brokers. If you go back to the first chapter, the competition between the brokers, the people who hold our money, has gotten so great that they need to make it easy for us to buy or sell, or we're just going to go to another broker down the street that's got the same spread, the same commission, but I can buy or sell it. So now every broker offers it. Very easy. Another, not pro or con, but another important point to keep in mind is that stocks are traded as one company. If you're buying Apple, you're buying Apple. If you're selling Apple, you're selling it. Of course, you can do options on it. You can buy puts, you can sell puts, you can buy calls, you can sell calls. That's not my wheelhouse. So just understand, Forex pairs are done with two. You need a base pair and a quote pair. Euro USD, euros to dollars, euros to yen. You need two pairs or you don't have anything to see an exchange rate between. And we are going to talk about, of course, trading that exchange rate. That's where we see our price movement. We're going to trade the exchange rate moving from 127 to 128. People will buy Apple at 68 and ride it to 78, of course. But just keep in mind, it's two currency pairs or it's not something in the Forex market versus stocks, it's just one name. The other thing, and I did say this before, it's very rare that you see currency exchange rates go to zero. They will go to close to zero in some situations, and they'll go to hundreds. You saw euro to yen is 120 in that picture. They very rarely, though, will disappear, and that goes back to my point from earlier today of the question that people ask me about fiat disappearing. If the yen was to disappear, all the pairs that are being exchanged with the yen naturally would also not exist. So keep in mind that as these currency rates do not go to zero, the only way we could lose a currency pair is if one currency was to be erased from society, which I don't see happening anytime soon. Let's keep going. I have a couple of more here. Liquidity. You've probably heard that word before. Basically, the way that I explain it in simple people terms, liquidity is how easy can I get in and out of the market. If I buy it, do I get filled right away at that price that I see? Or does it take 10 minutes? You know, some Bitcoin transactions take a while. Sometimes with the Bitcoin transactions, you can lose money as you're moving Bitcoin around. Not in the Forex market. When you see a price, because of that low competition, because of the availability of the ECNs to get you the best price, your order normally gets filled at that price. Whereas you can look at other markets that are smaller, like stocks, and sometimes that does not happen. So the fact that the market is so big, it's large enough and competitive enough that it's easy to get in and out of these trades. That competition just breeds excellence. We all know that, right? Like in anything. So it's done the same thing to Forex. This is a big one for me, and it was one of the reasons why I never really liked stock trading to begin with. You have these guys like Elon Musk that can just tweet things and move a market. So why would I trust to be trading that company knowing that that guy could just tweet something and change the price action? More importantly, if he's that powerful for the good, what happens if Elon Musk was to get killed? What would that do to the stock? The company itself, Tesla, could still be great, but if Elon gets offed, then what happens? Does the stock go to zero? And that had nothing to do with your analysis. There's no way you would have even seen that coming. And that's, again, one of the things that I think Forex has a pro in versus stocks. Forex is so technically driven. That means that it's driven based on price action versus the rumors and the news and the influences that you can find with stock trading. Now, leverage is something that people always wonder. How much leverage do I need when I trade Forex? Forex pairs don't normally move more than 1% in a given day. So how do you make money if it's only moving less than 1%? You do need leverage to lever up those smaller moves. We're going to talk about how they're measured in a couple of chapters here. But just understand that the leverage is not needed to the extent that you've probably seen it on social media. 1 to 100 leverage is not necessary. If you're using high leverage, you're trying to flip your account. That's not professional trading. That's not successful, consistent, and building a profitable trading business. That could make you a couple $1,000 here or there, but you're also going to lose a lot of money trying to do that too, because you can get your whole account wiped out in one trade. So with leverage, just be careful. It's always up to you. Even if you were to go to some of these sketchy brokers based in Cyprus and use their services to trade your account, you can lower your leverage. You don't have to take, some of them offer 1 to 1,000 leverage. That's ridiculous. You can blow out the whole account in one trade, possibly. So lower leverage is smarter, it's safer, and it's just, again, you don't need a lot of leverage in Forex versus some of these, stock traders. They're using leverage on their stock trading or they're using leverage on their crypto trading. So leverage is always going to be there. It's about you choosing to not over leverage your account. It's just decision making. People will say trading is gambling, trading is a scam, but you over leveraged your account and you wiped it all out in one trade. That's not even trading. Yes, you're actually right. That is gambling. To put all of your entire account, whether it's $100, $10,000, $100,000, to put the whole thing on black or the whole thing on one trade is just gambling. It's not trading. Understand that. The last thing, margin. When you hear margin as a stock trader, it's a loan. In Forex, it's not. So it's the same word, but it's defined differently. In Forex, it's the amount of money that we put with the broker as basically like a goodwill deposit. And then they give you, maybe let's just use 1 to 10 leverage on that deposit. So you can trade it as if it was more money to take advantage of that smaller percentage move that the currency pairs are moving on an overall day. Now, there will be currency pairs that move more than 1% some days. Absolutely. It's just not common. And that's why we do need a little bit of leverage, a little bit more than stock traders use. However, anything over 1 to 20, in my opinion, is too much. And in America, we have regulations where the highest leverage a broker can give you is 1 to 50. But some of the currency pairs with those brokers, they don't even give you the full 1 to 50. They're giving you 1 to 20, 1 to 10. So they can adjust that as well. And they're doing that to keep you safe from volatility. Those are the main pros and cons. I wanted to show you visually here what that difference of trading sessions looks like. So now here's our first chart of the course. Now we're getting into some fun stuff, right? We all love that. But just notice here, we have our first thing that's important, which is that vertical line. You've got 2 of them right here, and they're dotted lines. You're going to see those a lot. Those are called period separators. That shows the end of the day. So if that shows the end of the day, the first session is our Asian session. That's when the market opens. That would be like Sunday evening New York time, but that's their Monday morning. So that first 8 hours is the Asian session, the second 8 hours is the London session, and the third is the New York session. And you can see I've got it broken up into nice boxes for you so you can visually see that. And then what happens the next day after that period separator is we go right back into the Asian session, and it never closes. So you don't see gaps very often. You don't see anything crazy happening day to day, whereas with some of these stocks, here's your pre-market trading, here's your end of day, here's your actual market, and then here's your post-market. And then look at this huge gap right here. Price was up here near 145, then it gapped down to 142 the next day. That's one of the biggest differences between stocks and Forex, and you'll never see those big gaps. I won't say never. It's very rare, very, very rare that you'll see those big gaps. The only time you're going to see those gaps in Forex is when you're around a major news event. Major, like a Brexit, like a once in 10 years, once in 20 years kind of thing, right? That's when you might see gaps. So like when Brexit happened, we saw, I think it was pound dollar moved had a very large gap. But that was anticipated. We knew that they were having a meeting. It was live streamed all over the news. You shouldn't have been in any trades. That's what we teach. You should never trade through those high impact events. Anything that draws the attention of the masses, if you can't already tell, turns me off. I don't want the rumors. I don't want the news. I want technical charts. I want beautiful price action like you see here. I don't want gaps like you see here. I don't want any of that. That screws up my technical analysis, my price action analysis, and that's where we have found consistency in trading. It's not fundamentals. It's not forecasting, this is going to happen, that's going to happen. It's what is price doing? Let's react to that. So now I want to go into more detail about what a currency pair actually is and what are some of the currency pairs that you and I are going to be trading.